Good morning, everyone. My name is Porfirio Coronado. I'm with Dallas Area Habitat, and what better way to start a day than celebrating Selena's 50th birthday today, as we learn about home ownership. So, thank you so much for joining us today. We have Blaine Coward, our senior director with Dallas Area Habitat Homeownership Program, and today we're going to be discussing, like I said, how to turn your stimulus check or any kind of savings into buying a house. Um, so just a reminder, this is day 5 of our financial literacy week. And if you are just now joining us for the last day, just a reminder, these classes are recorded. So if you would like to go back and watch those on demand, you are able to. Feel free to always share the information with anyone that can benefit from any topics that we might have covered. Again, thank you so much for joining us today. And let's kick it off.
Let's kick it off. First of all, good morning, Porfirio.
How's it going?
I'm so excited to be here. We have arrived, y'all. We are on day 5, the final day of this awesome event. I see so many familiar names, which I love. I know y'all have been following us all week. Thank you for joining us. And kudos to you. Congratulations to you for making this commitment to yourself all week and to your financial wellness. We love that. And we're something, that we are super passionate about at Dallas Habitat. Today, I'm so excited, Porfirio, to talk about this subject because, stimulus checks or, who calls them stimmies? Shout us out in the chat if you're calling your stimulus check your stimmy. By this time, many of us, if you've received a stimulus check, it's your 3rd check that's come in. This is, for a lot of people, I think, unfortunately, we know COVID has hit a lot of people really, really, really hard over the last year. For, any of us who have been incredibly fortunate enough to keep our jobs, on the other hand, this is great, great bonus money.
Right. Yeah.
And we should be asking ourselves, right, Porfirio, like, what are we doing with this? Does this money have a job?
Right, exactly. You said it's the money that we're not expecting, so we call it like mad money,
Yes,
so money. That we didn't expect to have, right? And that we just have now. But yes, Blaine, you said that this is a time of the year where, a lot of us are expecting this type of bonus or tax refund, right?
Yes.
And also the stimulus check. I don't know, but if you know that last year, 80% of the taxpayers receive an average of $2,895 in tax refund.
Right.
Yeah.
$3,000 in tax refund. That's on average.
That's on average, exactly.
Wow.
What do you think that a lot of people would be able to do at least with $2,000, $2,800 in tax refund and to save it towards upfront on a house, right? But not only that, like we were talking about stimulus.
Mm-hmm.
So a lot of them also received an additional $1,400 for stimulus, right? And then that adds up more if they had children.
Yeah, I was going to say, like this most recent round that came out in March, if you've gotten your stimulus check in March, give us a shout in the chat. Y'all, we want to hear from you. It's Friday. Give us some love in the chat. Yeah, I mean, if you have kids, there is an amount that you're getting for each of your children in addition to your $1,400. And then if you have a spouse, potentially that individual also qualify for $1,400. This is a lot of money. Y'all, this is a lot of money.
Yeah, like I said, right now, in an average, it's like about $4,295. That's just an average between what you're expected to receive plus the $1,400. Right?
Like in your tax refund plus your stimmy, as we're going to call it, plus that together. That's a lot of bonus money.
Exactly, and and what a lot of people are not noticing is like, what do I do with this money, right?
Mm-hmm.
A lot of times we're like, okay, well, I have 3 kids. Let me go buy them a pair of Jordans. Let's go get a Coach bag. Let's go, anywhere, right? And anywhere you go, you're gonna spend the first time you're gonna spend probably more than $100, right, on anything you buy. Oh, yeah. So why not take that money and turn it into an investment that is going to benefit you more later on, right?
Most definitely, yeah.
Possibly like home ownership, right? And what we're Dallas Area Habitat, we might be a little bit biased on it, but I mean, you could also pay down debt, right?
Right. We're going to talk about both ways. We're going to talk about both saving that aspect of what you can do with this money and also paying down debt if that is your biggest obstacle to home ownership. But one side note I will say to your comment, Porfirio, about like first thing we do a lot of times when we get mad money that comes in is, what do my kids need? If I'm a parent, right? Like, what do my kids need? What have I been putting off or delaying? And we would say, look, y'all, what better gift could you possibly give your children than the gift of generational wealth building? Okay. We're just here to keep it real and say, like, if we have our eye on the prize, long-term, reaping long-term benefits and our long-term goals, this is it. And we'll say, this year, I think tax refund season is always a great time of year to think about how we're harnessing this money that comes in to our bank account that we really weren't like banking on in like maybe January or February. But this year in particular, with the stimulus, the arrival of that stimulus check in March simultaneously, if that money is still sitting in your account, you still have a possibility at this moment to make some big money moves. So we're gonna talk about that today. So one thing I wanted to share about a little bit in more detail is how specifically we can leverage this money to save for our upfront costs, right? So let's talk for a second to Porfirio about like what upfront costs are. Yeah. And again, give us a shout. We want to know if you are in today's meeting and your goal is home ownership, let us know. We want to know that. And I see, by the way, Janie, we see you in the chat. Janie, we know you. Janie's in our program. Kudos to you for being here today. And Janie said, hey, I have two kids and I got mine already in March. And so that's awesome, Janie. Hopefully that money is sitting, waiting in an account, waiting to be given a job. Elvira says her goal is home ownership. We love it. You're in the right space then, Elvira. So talking a little bit about saving for upfront costs. When we talk about upfront costs of home ownership, there's sort of two big buckets, okay? Right. Not exclusive buckets, right? But like two big buckets. And we would say that those buckets are the down payment and closing costs, right. Okay? Not one and the same, right, Porfirio?
No, yeah. So let me just explain what closing costs are. Right. A lot of times, a couple of y'all are in the homeownership program, and we discussed this as our initial counseling session. Right. Mm-hmm. We discussed about down payment and closing costs. So closing costs are costs associated to the loan that you are getting, the underwriting loan and all that, and then also costs associated to the house that you're purchasing. Right. So those both products are incurring costs independently, that at the time of closing, they are passed down to you. So that could be like the title work, the appraisal, the credit report that your lender pulls, the survey, everything that has to do with the home ownership, the home that you're purchasing, and then also the loan that you're getting to purchase the house, and all that is combining to closing costs. Okay. Mm-hmm. So, that's what a way that you can start saving, because on average, closing costs could be about 3%, 3 to 5% of the purchase price of the house that you're purchasing. Okay. So we like to explain what down payment assistance is, Blaine.
Yeah. So thank you for that explanation, Porfirio. So, just to tag on to that, one way we can think about closing costs is that closing costs is just the amount that your bank or financial institution is charging you to generate your mortgage loan. These are costs associated with the loan itself. Like Porfirio said, title work, right? These types of things, a survey on your property, any loan origination fees that might be charged. These are all closing costs. Anything we pay in closing costs has nothing to do with how much money necessarily that we're going to be borrowing, unlike a down payment. Okay, a down payment is the amount of money that we are putting towards the cost of the house. And that down payment, that amount that we put down, is immediate equity in the home. Okay, so that's the fundamental difference between a down payment and closing costs. Closing costs, just costs. They're pure costs. We're never going to see that money back. It's just part of the transaction of getting a mortgage loan. Okay, unlike a down payment, the more that we put down in a down payment, the more equity we have in a house. So generally speaking, this is where you begin to, hear about some myths that I think exist about how much money realistically we need to be prepared to save for a down payment. Sort of in the older days, there was this golden rule, right, of like 20%. down. Well, think about what that number is for a second, y'all. Right now, in today's housing market, you're going to be hard pressed to find something affordable like under $200,000. Is it out there? Sure, it's out there, but it is a very competitive market in that range. I mean, you're up against cash investors, right? So people have no contingencies. There's no mortgage complications. They're just here to say to a seller, you're selling this house for 180, here's 180,000 in cash. Well, who's going to say no to that? Okay, so that's the hard thing in that price range, right? So let's say, for instance, you're looking at a house of 200,000 to make it easy math. 20% as an idea of 200,000, that's $40,000, right? Like most of us are not sitting here saying, yeah, I've got $40,000 to put into a down payment and I'm good. No, so, really, that is an outdated idea of how much we need to save for a down payment. There are some really fantastic, fabulous programs that exist. Habitat offers a program like this, but also, many banks and financial institutions offer first-time loan products specifically for first-time homebuyers with low down payment requirements. When we say low down payment requirements, we're talking somewhere between, it could be as low as 3 to 3.5%. Okay, those could be a conventional product, meaning that this is a loan that is a product of the bank itself. And a lot of times those conventional options that are backed by the bank, really don't require what's called private mortgage insurance, which is a fee that if we don't have to pay it, we don't want to pay it. Tends to be if you have less than 20% equity in the home, meaning if your down payment is less than 20%, traditionally you would be required to pay what's called PMI or private mortgage insurance. But with some of these great conventional low down payment options that many of our partners at Dallas Habitat offer, you may not have to pay PMI. And then of course you have FHA, which a lot of people know about FHA, right? This is a government-backed loan product. And with FHA, the minimum requirement is 3.5% down. Okay, so there are some really great affordable options that are out there. But again, those are sort of minimum down payment targets, 3 to 3.5%, right? So again, not necessarily as high as 20. You may be able to qualify for something as low as 3 to 3.5%, or it may be a little higher than that, depending on your financial profile and what you can get qualified for. So I think the moral of the story here, all in for upfront costs, is like Porfirio talked about, closing costs can be between 3 to 5%. Your down payment is going to be minimum 3 to 3.5%, maybe more, right? So all in, we're looking at being prepared to pay at least like 6 to 7% in upfront costs of the cost of the home, right? Like if not more. So that allows you to be able to back into this. Hopefully, if you're really serious about planning for homeownership this year, you might be taking notes on some of this, right? To make sure that you can go back and begin to do the math. If I'm looking at homes priced in this price range, how much am I going to have to be prepared to potentially put down in a down payment and closing costs? And then any additional costs that might exist. Porfirio, we know that closing costs and down payment are the biggest part of upfront costs, but they're not the only costs.
They're not, no, because like I said, you also need to probably pay down debt, right? In order for you to get there, to be able to have a loan on your credit. So that's one. And then also, what about moving expenses?
Yes.
Right.
Moving expenses, utility deposits.
Exactly.
Everything that goes into just moving into a new place. Plus, Porfirio, you want to talk a little bit about what reserves are?
Yes. All right. So reserves are, so typically a lender is going to ask you to have reserves, meaning that you have money in your bank for at least 3 months of your mortgage payment or your everyday expenses. Okay. So for example, if your mortgage payment is, just for easy math, it's going to be $1,000 per month. They are going to want at least 3 months of reserves. That's going to be $3,000 extra outside of your down payment and closing costs. Okay. So, which is why we always urge the emergency of save, save. because you never know if the lender that you're going to go with is going to ask for those reserves of requirements. Now, not all of them might ask it, but most of them will. Okay. So, which is, like I said, which is why we are in our counseling program, and we always preaching like save. Like if you are in our classes, we're like, okay, how's that savings? Yeah, if you're in our counseling program, we are always emailing about your savings, right? But that's the reason, because there is so many costs associated to the mortgage that you're going to be getting, and then later on, once you already have a house, right? You probably want to furnish the house, right? Because new house, new furniture, new life, new everything, right? So there's some other costs you're gonna have to pay, right?
That's a great point, Porfirio. And I want to add on to that quickly, because I see a comment that came to us in the chat asking, do investments count towards this? So that's a great question. I would say very high level. First of all, it depends. It depends on the type of investment, right? More often than not, we see that most of the investments that clients who we work with have tend to be retirement accounts. So like a 401k. Technically, you can borrow against your 401k to be able to make a large purchase like a home purchase. However, major asterisk next to this, right? Even though we can do that, we should be asking ourselves, should we do that? And the reason that we say this is because, as we talked about, if you joined us on Wednesday, and Wednesday of this week was our Invest Like a Pro day. And we did an awesome session that morning, our 10 a.m. session on 401ks. And the beauty of long-term investment for retirement, like 401k, is that it only works if you set it and forget it. If you got to put it in there and then let it grow. If we're dipping into our investments as though they're savings accounts, they're not going to give us the outcomes that they should be giving us. Meaning, we're sort of robbing Peter to pay Paul, right? We want to be saving for retirement and for homeownership, but if we're using only one account, it doesn't allow us to achieve both of those outcomes. So at Habitat, we normally would suggest that you think twice before dipping into something like your 401k, if that's the type of investment account that you're considering. And instead, this is why we talk about, when you're getting tax money, when you're getting stimulus money, when this money flows through your account, that's bonus money potentially, right? Like that's that mad money. Let's give that money a job. Let's put that money towards down payment. Let our retirement continue to grow. Because I think it's still safe to say I don't want to be working when I'm 85. And I'm sure I'm not the only one, right? So we would say, if possible, let that money be. Technically, can you do it? Yes. But I think, from our financial advising perspective, and Porfirio and Aretha, our other counselor at Habitat, they are certified in this, and they're going to tell you, think twice before you dip into that. But that's a great question.
It is a good question because, like you mentioned, on Wednesday at 10 a.m., we did the class on 401ks and, compound interest. So, which is why you want to be careful. You're going to be borrowing from that, because otherwise you're going to lose that opportunity to actually make more money in the long run.
Yeah.
At least $5,000 right now. When you could have used your $5,000 that you receive on a tax refund to pay what you needed to pay, or do what you needed to do with it. So like Blaine mentioned, I would think twice about borrowing from retirement account if you're going to be purchasing a house or any other type of just borrowing from it in general. Because it's there for a reason, right? It's there for you to retire later on, right? So like Blaine said, you're gonna thank yourself later once you're retired. You're like, okay, good. I think I need to take this money out.
So savings for upfront costs, probably the best way that we can put this money to work for ourselves, right? But Porfirio, I think sometimes we know, based on our debt circumstance, it may not be our income or even maybe our savings that's holding us back. Like maybe our income's pretty strong and we have money in savings, but maybe we cannot afford, or we don't have the purchase power that we want. We can't afford the house that we want because our debt's too high. If that's our circumstance, can you talk a little bit about how we might leverage this money to pay down our debt?
Yeah, so like Blaine said, it might not be that it might be that you already have enough savings. Like let's say you probably have about 6% saved already of the total loan that you're borrowing, right? So you can pay down debt instead, because that might be the what is holding you to be able to afford your max loan amount, right? So for example, if you take your monthly gross income and multiply that by 40%, okay? So that 40%, it's going to be the total debt that you can have on a mortgage, okay, or like on your own credit, right? Now, we also have to discuss your front end ratio, which is the 30%, right? So if you take your gross income and multiply that by 30%, then that is the max mortgage payment that you can have on your credit based on your income, okay? So the difference between the 40 and 30, that's 10%, right? So if you multiply 10% times your gross income, that's your total debt outside of your mortgage that you can have on your credit, right? So, which means that if you're only able to afford $200, right, on your credit outside of your mortgage, but your overall debt that is on credit, it's actually 250, right? So you might have a credit card that you're making a monthly payment of $50 a month, and that balance is like $2,800, right? So then it would benefit you to use your stimulus check, your tax refund, to pay those $2,500, because that's what's holding the $2,800. That's what's holding you back from being able to make it affordable to where you get to $200 a month. So that's just one way that you might think about it. What am I able to afford to pay and regarding to my income? And Blaine in there in the chat, she put the ratios, okay? Which, like I said, 30% is your max mortgage payment that you can pay based on your income. And then between 40 to 43%, it's your total debt that you can have between a mortgage and all the other debt. So the difference between those two, like I said, it's just your debt outside of your mortgage of what you can afford.
And so that might include, for instance, when we talk about what monthly debt may include, could be car payment. It could be student loans. If you're making a monthly payment on your student loans, it could be credit card debt, personal loan debt, right? It could be a combination of those things. So again, depending on your financial profile, and we would say at Habitat, if you're not sure whether to put this money towards a upfront savings or towards debt, first of all, we would say, if you're working in our program, always consult your counselor. Always consult your counselor. Sometimes we're quick to say, we get this mad money in the door, and we're quick to say, I want to be debt free before I buy a house. I want to pay off my car entirely. Well, sometimes it's not necessary to pay off our car entirely, for instance, but it is necessary to have, $6,000 saved for upfront costs. So if we rush and we pay off that car that maybe wasn't even holding us back from qualifying, but we don't have enough saved, we haven't made any progress, right? So be savvy before you rush and make a decision on these things. Seek financial advice. Consider consulting Habitat. If you're not in our program, you might be interested in looking into that, right? We offer a counseling program specifically for this purpose, but be mindful of that.
Right, and you mentioned that that car might not be holding them back, like you mentioned, and saving was. And that just reminded me of a situation that I had like that, where I had a client in my program where that was the case. She wanted to get free, and next thing you know, it's well, you paid off your car, but then you run out of money to pay for closing costs. So now we have to wait because now you don't have money for closing costs, but you paid off your car, which is good, but that was not holding you back.
Right. Right.
So it's kind of hard.
I think that's a great point. Is like, before we rush and make decisions, think carefully about it. And it starts with education, right? It starts with understanding, like we're doing today, kind of walking through pros and cons. Regardless, here's the number one thing. If you are planning on using this money your STEMI money or your tax refund, make sure that this money goes into a bank account. We cannot emphasize that enough. This money has to be deposited into a bank account. And if you're depositing into a bank account, it is incredibly important that if you intend to use this money for a down payment or for closing cost assistance, that if possible, you transfer the full amount. So for instance, if you do not have direct deposit set up with the IRS, and that money is not just directly hitting your account from the IRS, but you're getting it through a physical check, and then you're depositing it yourself, try to ensure that you're not splitting that check and like only depositing part of it or spending part of it and depositing part of it, because that's going to make it very hard for your loan officer to do what's called sourcing. And if they cannot effectively source that money, it could risk that it may pose a challenge for you to be able to effectively use that money in the way that you intend to use it. So be smart about that as well. And then the other thing, that is important is loan officers too are going to want to look to ensure that money has seasoned. Money has seasoned. And that just simply means that
Like
you've demonstrated self-control, right, Porfirio?
just like food, right? It has to
just like food. Yeah. It's better that way. It's better that way. It has seasoned, it has cured, if you will. It has sat in a bank account for a given amount of time. We're not talking about a year, y'all. We're not even talking about 6 months, right? But it demonstrates that we're not just getting money yesterday and spending it, on a down payment today, but it shows that we can show restraint and self-control and making sure that this money really is intended for savings and for the purpose that we're looking to apply it for. So
yeah, keep in mind what you are trying to do is show the loan originator or your lender that you are well trusted with, right? Because remember, you're going to be borrowing probably the largest loan amount that you would ever probably borrow in your life, right? So you have to show them that they can trust you with that much money, right?
Yeah.
The way that you can show that is that yes, you do have savings, you do have a stable income, that you do can restrain yourself from just overspending if you do have reserves, right? So now, before we leave, Blaine, I know that we're right on time. One big mistake that a lot of people are making right now and that I don't like to see is people are taking this stimulus check and purchasing cars. Right?
No, don't do it. Don't do it.
Right? And so so I can preach here all day about like, before you even purchase a car, I know a lot of times, a lot of us have troubles and all this and that. But before you purchase a car, and then also if you're thinking about purchasing a house, right? Always consult your loan originator or loan officer, wherever you want to get your loan with, and see what's your total debt, right? Because they might say like, well, yeah, you're at 43% now, or you're close to 43% on the back end. Then what that means is that if you're add another debt where you paid with your stimulus check as a down, right? You're going to be paying probably another $400 a month. Then you're not just over 43%, you're just over 43% in debt, but then also you run out of money for savings, right?
And you just got a car, which means you just got your credit pulled, which means you probably saw a dip in your credit score. Right. So just overall, not a great thing. It's all about timing. It's all about timing. And we say when you are ready for home ownership, the house comes before the car, period. Like the end, because that is the number one thing that we see a lot of times will kick people out of eligibility for being able to buy a house. And so, just be thinking about that. And we had a comment coming, it may not be enough money to buy a car. It may not be enough money to buy a car, but it may be enough for a down payment on a car, to finance a car. And so that's still, like I said, to Porfirio's point, if you're financing a car, that's going to be factored now into your DTI. So just be mindful of that and think about, if this is your year for home ownership, what can we do to make home ownership a priority? And once you're in your house, then no one's analyzing how much debt you have, and you're free to go out and, you know, get a car, whatever you may need to do, but be smart about that. So I think, you know, in summary, really the moral of the story is this is bonus money, y'all. This is bonus money, and we may never have an opportunity quite like this, like we do this year, to get this much money into our hands that really wasn't necessarily expected, and be able to leverage that to achieve our financial goals. And homeownership, what could be better? What financial goal could be better than buying a house and investing in ourselves and our future? So yeah, we encourage everyone, think about that. If you have not spent that money, give that money a job in your budget.
Exactly, exactly. And it all starts with, you know, mind setting, right? Setting your mind that, like, yes, my goal is to purchase a house, or my goal is this, and where could I use this money upfront?